Hello and welcome. You're watching Business Today TV. I'm Sakshi Batra, and joining in on this special, I have a very, very special guest. Mr. Sanjeev Bhasin joins in, Executive VP for Markets at IIFL. Welcome, Mr. Bhasin, and thank you so much for taking the time out. Well, Sensex has scaled 60,000 after 4 months. Help us understand what is really leading to this optimism and what lies ahead.
Yeah, hi. So, Shakshi, the left out feeling is humongous. We were grossly oversold. Fear was at its highest. And you saw almost despondency and capitulation. And
Correct.
all led by the so-called foreign investors who have been, really at the wrong end of the barrel. And now you are seeing retracement. So I think that we were very, very oversold. We were all following cues of the US, which were not so, for once in 70 years, we had a reverse, what we call a reverse opposite reaction. Given
Correct.
that our inflation, our yields, and our local business was responding very strongly. And last but not least, it's the wall of retail investors who's put his money where his mouth is. So this is the, what we call the 75th year of independence. And this is truly a year of celebrating the coming of the retail investor, and he's here to stay.
Absolutely. So the retail investor is here to stay. We'll just get to hear about the FIIs as well, whether now they are here to stay or not. And if the worst of FIIs selling is behind us, what's your take on it?
No, see, there is no gauge. When you were oversold, there were 78% short positions and so on. It was telling you that a lot of the dumb money or the capitulation as far as ETFs were through. Now, fear doesn't come announced, neither do events. You have to be brave enough to weather the storm at that time, Sakshi. And these opportunities don't come. This 1 month or 1.5 months is the best in the last 2 years. Mark my words. I track derivatives throughout the day, and I cannot but tell you how much money the last 1.5 months has come. But Sakshi, you had to weather the storm, meant that you had to be in the market in the last 3 months and see the pain. Only then the gains will come. The FIs are, like I said, we've had too much of dependency and too much of hobnobbing about them in blue-collared ties. That doesn't work now. This is the Indian sheer weight of the retail investor. So the FIs are definitely feeling very, very left out. But I would be very, very cautious at these levels. And if you have been following us or IIFL Securities or some of the channels, this is the time to take home money. Money is that which comes home. Don't wait on book profits.
Okay, understood that. Time to take the money home. So this year we've seen it all, Mr. Bhasin, just like how you pointed out. First, there was a euphoric start, then came the fear, a reminder that equities will be volatile. Just when they turned volatile, they managed to bounce back very sharply. But do you think a lot of those macro headwinds that came in with this year, 2022, are now behind us?
See, markets are all about greed and fear and opportunity, and the cause and effect of the Russia-Ukraine war, the escalation in oil, the bond yields, inflation. But all that tells you that stock prices have weathered the storm. When they gave you that opportunity, Indian retail market was telling you that a large part of the reopening trade, the demographic premium of India is going to play out, and for once. I think that everything, all hell broke loose against the dollar. But given a basket of currencies, I think India has been a relative outperformer. And all hats off, like we said, to the, corporate India, which has only shown results which are far ahead of estimates. So, like you said, there are no free lunches. We think that a large part of the capitulation may have played out, but stocks are not cheap now. You are up about 20% from the recent lows. So you will have to gauge through the time. The markets need some consolidation, stroke, little bit of correction. But, the greater part of the fear of the Fed rate tightening, the bond yields, all is getting priced in. In fact, the NASDAQ itself is up 24% from the June lows, which tells you how much of despondency there was and how much of feeling of missed out now there is on the table.
So, Mr. Bhasin, just help us understand that we are still 4% away from the all-time highs. The broader markets still have to play catch-up. But when the valuations were lower, just like how you pointed out, the last 1.5 months, what kind of big changes did you make in your portfolio? What did you really add?
So, see, we are looking for a mix of stocks. If you want, I can mention 3-4 big ideas. So, and we have been doing a sip in that. Firstly would be Ambuja Cement. We think the the takeover of Ambuja and ACC by Adani means that they get the 35% of cement costs is power and infrastructure. And automatically, Adani being in the best place for that, Ambuja becomes a star player. Secondly, DLF, if you came to Delhi or Gurgaon, you'd see that there is no space vacant, whether commercial or real estate or individually. Houses are going through the roof and real estate prices are here to stay. Plus the largest players, DLF, Godrej will be laughing their way to the bank as prices rise and occupancy picks up. Thirdly, Kotak Bank, I think, which is one of the best pedigree private banks, which has never had any issue on NPAs and which I think can be a very, very steady performer. And fourth would be HCL Tech, which I think that definitely will be a very, very key beneficiary of IT spending. And, the whole despondency was that spending budgets will go down, but outsourcing continues to be a very, very key theme. And you can add a Ashok Leyland and a Tata Power, which I think in their respective businesses are doing the best they've done in the last, maybe 10 years. So these 5-6 stocks, if you did a SIP, even though the stocks have gone up, a SIP would be ideal because then the next 6-12 weeks, you'll get a large part of the volatility in the prices.
Mr. Bhasin, in terms of the sectors, where do you find value in the current markets?
Well, it's across the board. 2 years back, nobody was touching auto, even 6 months back. And look at the comeback. Look at what Mahindra is telling you, that they've been planning on EVs from 1999 and their new launches are going to, take your breath away, if I use a cliche. Same is the case with Hero, same is with Eicher, Maruti. They are ruling the roost because the semiconductor issues have been sorted and demand is so strong that they've got 9 months waiting. Same is the case with banks. When the CASA ratios improve, then the low cost of money will help the large lenders. And we've seen credit offtake being very smooth. Thirdly, but not least, I think stocks like Tata Power or Ashok Leyland, and thirdly, DLF, these would be very, very key beneficiaries of capex spending and, buying in real estate and autos.
Also, lastly, Mr. Bhasin, I want to understand from you, where do you see the Nifty progressing now towards, since we are closer to 18,000, 60,000 on the Sensex, where exactly do you see the Nifty inching towards the end of the year and the years going forward from here?
That's a tough one. You called me after we've had an 18% breathtaking rally. But I still think by Diwali, we should be at new highs and we'll take it from there. I've been sticking my neck out all the way from 15,500, proven correct. So I think new highs are here by Diwali. And then we'll wait for more results, more color on the Fed and some of the, local issues which get sorted out. But let me tell you, Sakshi, don't miss the woods for the trees, because it's not the next 3 months, but look at the next 3-5 years. And you cannot have a sweeter spot than equities, at least in the Indian context.
If you like the video, do like, comment, share and subscribe.